Welcome back to the deep dive. Today, we're unpacking some really interesting financial reports. We'll look at market signals from Seoul, even some overheating warnings, and then shift gears to, well, European real estate debt. Quite the mix, right? Our aim, as always, is to cut through the noise and get to the core insights. Now, if you're watching the Asian markets, today was quite a day. The main index in Seoul took a pretty big hit.
Yeah, significant drop, over 100 points down.
Exactly. But here's the twist. At the same time, retail investors, everyday traders, they piled in.
Piled in is right. Huge volumes, historically high, actually. It's this real divergence we're seeing.
So the market's dropping sharply, largest single-day fall since last September, you mentioned.
That's correct. Volatility is definitely the word.
Yeah.
But the retail reaction, it's kind of astonishing. Our sources show that just in this one session, these individual investors bought, wait for it, 2.68 trillion Korean won worth of stock, net buying.
Wow. 2.68 trillion won. Just to frame that, that's roughly, what, 2 billion US dollars?
Right.
In a single day.
Yep, during a major downturn.
That's either immense confidence or, well, a massive bet.
It's the biggest single-day retail buy since the peak of the Dongak Ant movement back in 2021.
Ah, the Dongak ants. I remember that. The wave of retail buying during the COVID dip, believing things were undervalued.
Precisely. They saw a structural opportunity then. And it seems like we're seeing perhaps an echo of that now.
Because this isn't just today, is it? It's been happening for a bit.
Over the last 7 trading days, yeah. They bought almost 4.5 trillion won on the main board alone.
So it's more than just buying the dip. It suggests they believe this isn't just a temporary bounce, but something more fundamental.
Exactly. The underlying feeling seems to be that the market's in a structural shift, a growth phase. And you can see why they might think that, I mean.
Well, the performance has been stellar, right?
Absolutely. The main index is up over 71% year-to-date. Globally, that's #1 performance for a major market this year.
71%. Okay, that figure certainly grabs your attention. But after such a run-up, you have to ask, what's driving this belief? What are the fundamentals making people think there's still more room to run, despite the risks?
Well, our sources are pointing to 3 main things. First, and this is a big one, the AI semiconductor supercycle.
Right, the chips. HBM, DRAM, NAND.
Exactly. Exploding demand for high bandwidth memory, HBM, plus better prices for standard DRAM and NAND chips. That translates directly into much better earnings for the big Korean chip makers.
We've seen some crazy stock moves there. SK Hynix.
SK Hynix is up over 240% this year, just this year. Samsung Electronics has also seen significant gains, especially recently. So there's real earnings growth behind part of this rally.
Okay, so chips are #1. What else?
Second is policy expectations. Hopes for government action to boost the capital markets.
And third?
Third is the macro picture. A potentially weaker dollar and the growing expectation that the U.S. Fed might start cutting interest rates.
Okay, those are 3 pretty solid pillars. Chips, policy hopes, and Fed easing. But, like I said, with a 71% gain already, isn't a lot of that good news baked in. Which brings us to the tension, right? This retail enthusiasm combined with, well, debt.
And that's the real worry here, the leverage. The amount of margin debt, BIT2 as it's called, debt-funded investing, is setting off alarm bells.
How high are we talking?
The current balance is around 25.46 trillion won. That's getting uncomfortably close to the all-time peak we saw back in 2021 during that last big retail surge.
And when you have that much borrowed money chasing gains, even a small pullback can get ugly fast, can't it? Forced selling.
Precisely. A correction could easily turn into a cascade if margin calls start hitting. It's not just individual losses, it's the systemic risk of accelerating a downturn.
So it's not just analysts worrying. The regulators see it too.
Oh, absolutely. The Korea Exchange is issuing warnings at a much faster clip this year.
Tell us about those warnings. How serious are they?
They have designations, and the highest level is investment risk. They've issued 25 of those this year already.
25 compared to what, last year?
Last year was only 10. So that's a 2.5 times increase?
And getting that risk label isn't easy, right?
No, it's strict. A stock usually needs an investment warning first, and then it has to jump another 45% within just 3 trading days. The fact that it's happening so often tells you there are a lot of stocks going almost vertical.
And here's a key point our sources highlighted. It's which stocks are getting these warnings that's changed.
That's a crucial shift. Historically, these high-level warnings, they tended to be on smaller, more speculative stocks. Maybe theme stocks.
But not anymore.
Not this year. Now, these warnings are increasingly hitting large-cap, blue-chip names, big, established companies.
Which suggests?
It suggests that the combination of, Policy optimism and all this liquidity sloshing around is pushing even fundamentally sound companies into potentially overheated territory, at least in the short term.
Can you give some examples? Which big names have triggered cautions recently?
Sure. SK Hynix, which we mentioned earlier, its price has basically tripled in a year that got an investment caution. Others like LS Electric, Hyosung, major industrial players, they've also been flagged.
So when the big guys start getting these kinds of volatility warnings, it's a sign.
It definitely signals that market euphoria might be getting a bit frothy.
Okay, so regulators are warning margin debt is sky high. What about the brokers? The firms actually lending the money, are they just watching this happen?
No, they're not sitting idle. They're engaging in what some call speed control for this margin debt, risk management, basically.
How are they doing that?
Several major brokerages, like Murray Asset Securities, for example, have started to restrict new credit lending, or they're tightening the lending standards specifically for certain stocks.
Which ones are getting restricted? Is there a pattern?
Well, the list includes names like Kia, Hanwha Aerospace, Samsung SDI, even JYP Entertainment.
Okay, diverse group. What's the common link?
The common link seems to be stocks that have seen really sharp recent price run-ups, often fueled by concentrated buying from retail investors, sometimes linked to specific news. Like, Kia saw buying on hopes around U.S.-Korea tariff talks. JYP Entertainment saw interest tied to speculation about China potentially easing restrictions on Korean cultural exports, the Hallyu-wave.
And I guess when the exchange itself issues an official investment caution on a stock like SK Hynix, Hyosung, LS Electric, the brokers have to act, right?
That's right. It becomes mandatory then. Regulatory guidelines kick in. For 5 trading days after that designation, financial firms have to restrict margin buying on those specific stocks.
So it's a coordinated effort to tap the brakes.
Exactly. It's a preemptive move, trying to lessen the risk of a sharp sell-off if prices do start to fall, especially with all that leverage out there. Even if they still think the overall market might go higher, they're worried about the potential for a painful short-term correction fueled by debt.
That paints a really clear picture. A domestic market with, let's say, high potential reward, but also very visible, significant short-term risk, particularly for anyone using leverage. Now, if that kind of volatility feels a bit too intense, our sources pointed towards a very different kind of opportunity, almost the opposite, really, overseas in Europe.
Yeah, it's quite a pivot. We looked at insights from Christian Jansen at Nuveen Asset Management. He's making a strong case for European real estate debt right now.
Real estate debt, why is that looking attractive?
He argues it's kind of a sweet spot, offering the stability you expect from a loan, but with potential returns that are closer to what you might hope for from equity investments.
Okay, why Europe and why now specifically? What's the window?
2 key things are happening. First, the European property market seems to have found its footing after the pandemic and is starting to recover. But more importantly, Europe is facing a huge maturity wall.
Maturity wall, meaning loans coming due.
Exactly. A massive amount of existing real estate debt needs to be refinanced or replaced between now and 2028. We're talking potentially $300 billion worth.
Yeah.
So there's going to be sustained high demand for new lending.
Okay, high demand for loans. But where do asset managers like Nuveen come in? Aren't banks the usual players?
Well, that's the second key factor. Banks are pulling back. Tighter regulations mean traditional banks have less capacity, maybe less appetite to lend in this space compared to before.
Ah, so banks step back, creating an opening.
Precisely. This pullback creates a void that asset managers can step into. And because they're filling that gap, they can potentially negotiate better terms and achieve higher yields than banks might have previously.
Interesting. So what kind of yields are we talking about? If you said Korean real estate debt might yield, say, 5–6%, where does Europe stand?
Nuveen is apparently targeting returns in the low double digits. Think around 10% annually.
10%. How do they achieve that with debt? What's the strategy?
They're using specific approaches, primarily something called haul-on debt combined with back leverage.
Okay, let's break those down. Holland debt.
Simply put, haul-on debt is where a single lender provides the entire loan stack, both the safer senior part and the slightly riskier junior or mezzanine part, all wrapped into one deal. It streamlines things and lets the lender capture the full return profile.
Got it. And back leverage, that sounds like adding more debt on debt.
It is, but in a structured way. They take the initial haul-on debt loan they've made, which is an asset on their books, and use that as collateral to borrow cheaper funds from a bank. This leverage magnifies their initial investment and helps boost the overall return towards that 10% plus target.
So they're leveraging the asset they created, aiming for higher returns, but the core is still that underlying real estate loan.
Exactly. And the bet is that the structure still benefits from the relative safety of being tied to real estate,
Hmm.
especially the senior portion of that original haul-on loan.
And what makes debt fundamentally safer than just buying property equity, particularly when markets are choppy?
Well, Jansen's point was that recovery rates on real estate debt, if things go wrong, tend to be much better than for, say, corporate loans. And compared to volatile stocks, especially in markets like we just discussed with high leverage, debt offers potentially much more stable performance. It's an alternative for investors looking for yield without quite so much roller coaster ride,
Okay, that gives us a lot to chew on. We've gone from this historic retail buying surge in Korea, fueled by things like the AI chip boom,
but shadowed by serious overheating warnings, spreading even to blue chips, and record levels of margin debt.
leading to regulators flashing warning lights and brokers actively trying to pump the brakes on leverage.
And then we pivoted completely, looking at a potentially stable yet quite lucrative opening in European real estate debt.
Driven by that unique combination of maturing loans creating demand and banks pulling back on supply, using strategies like haul-on debt and back leverage to target those double-digit
It
returns.
really highlights the different risk-reward profiles available right now.
So the final thought to leave you with is that tension. Where do you feel more comfortable? Chasing potentially high rewards in a volatile, heavily leveraged market that's already run up 71%, or seeking potentially steadier double-digit returns from something like overseas real estate debt? Different strategies for different outlooks. Thank you for joining us for this depth dive. We hope this analysis gives you some valuable perspective for your own financial thinking.
We look forward to digging into the next set of reports with you soon.
Until next time, legal disclaimer. This content is for informational purposes only and is not investment advice. All investment decisions and liability rest solely with the investor.